Today, the new loan refinancing Dynamo continues in October. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, most banks in Australia are very reliant on mortgage growth to drive their profitability. So it's always interesting to see what the stats say about home lending in particular, which makes up, well, maybe 65% of total lending. And in fact, bankers will see some warning signs in the data, but that'll be largely masked by buoyancy in refinancing, which of course includes the good old equity mate, as borrowers grab property equity to pay off other debts and allow them to continue to spend. In fact, equity mate is the missing element in the current economic equation and helps to explain why spending remains high despite the rising cost of debt. So the ABS released their Lending Indicators series for October 2022. That's a release about new borrower accepted finance commitments for housing, personal and business loans. And they said the value of total new loan commitments for housing fell 2.7% in October 2022. That's seasonally adjusted, after a revised fall of 4.4% in September. And it was 17.1% lower compared to a year ago. New loans for owner-occupier housing fell 2.9% to $17.2 billion and was 17.2% lower compared to a year ago, while new investor housing loans fell 2.2% to $8.6 billion and was 17% lower compared to a year ago. The real focus, though, is on external refinancing, where the value of external refinancing for total housing fell 1.1% to $17.8 billion, but was 9.7% higher compared to a year ago. For owner-occupied housing, it fell 1.3% to $12.2 billion, but remained close to an all-time high of $12.5 billion seen just 2 months ago, while investor housing fell 0.5% to $5.7 billion. In fact, the ABS said, despite the October fall, monthly owner-occupier refinancing between lenders has remained at around $12 billion since June 2022, well above pre-pandemic values. Investor refinance activity has also remained high. The RBA cash rate increased 225 basis points between June and October 2022, which coincided with a greater number of borrowers seeking loans with lower interest rates from competing lenders. And of course, that is really the point. Many people have been on interest rates above the best in the market. And because of that, as rates rise, they've become more aggressive in looking for alternatives. And there are still some good deals out there if you know where to look, particularly for those with lower loan-to-value ratios. Now, the value of new owner-occupied loan commitments fell 2.9% in October, while the value of new investor loan commitments fell 2.2%. This month's fall continued the decline from record high levels seen earlier this year, though commitments remain above pre-pandemic levels, the ABS said. Now, in October 2022, in season-adjusted terms for owner-occupier housing, the value of new loan commitments for the purchase of existing dwellings fell 3.8% and was 19.9% lower compared to a year ago. For the construction of new dwellings, it fell 3% and was 3% lower compared to a year ago. And with the purchase of new dwellings, it rose 2%, but was 16.2% lower compared to a year ago. In October 2022, in season-adjusted terms for owner-occupier housing, the value of new loan commitments in New South Wales fell 3.4%. In Victoria, they fell 2.1%. In Queensland, they fell 3.3%. In the ACT, they fell 10.5%. In South Australia, they fell 3.2%. And in Tasmania, they fell 5.6%. And in the Northern Territory, they fell 3.06%, while in Western Australia, they rose 1.5%. And in October 2022, in season-adjusted terms for investor housing, the value of new loan commitments in Queensland fell 7.8%. In Victoria, they fell 1.1%. In South Australia, they fell 3%. In Western Australia, they fell 0.9%. In New South Wales, they fell 0.1%. And in Tasmania, they fell 0.2%. And in the ACT, they rose 2.6%. And the Northern Territories rose 1.6%. Now, in October 2022, in original terms, the new variable loan rate commitments funded in the month rose just 0.02%, while the value of new variable loan rate commitments for first home buyers funded in the month rose 2.3%, while the value of new fixed rate loan commitments funded in the month fell 0.1%, and the value of new fixed rate commitments for first home buyers funded rose 3.5%. Now, this is important because there's a big difference between a commitment made and a loan actually funded. And one of the things that we are seeing is there are many more commitments made than actually are drawn down and funded. Now, that could simply be a lag between approval and drawdown, or it could be potentially that people are getting multiple approvals and then not following them through. There is an important gap here in the knowledge as reported by the ABS, which we're going to look into in future months. Now, in October 2022, in original terms, the average loan sizes for owner-occupied dwellings, that's including construction, the purchase of new dwellings and existing dwellings, rose at the national level from $588,000 to $595,000. That's across all states, in fact, most notably in Victoria, which went up from $600,000 to $622,000. And I think it's worth noting here that those equity drawdowns are part of the story. In October 2022, in season-adjusted terms for owner-occupier first home buyers, the number of new loan commitments at the national level fell 3.2% to 8,576, after a revised fall of 4% in September. The October level was 47% below the January 2021 high of 16,187. It fell in Victoria 4.1%, in New South Wales 1.7%, in Queensland 1.3%, in Tasmania 14.6%, in South Australia 1.9%, in the Northern Territory 8.1%, and in the ACT 2.3%. There was no change in Western Australia. Now, the point here is that first-time buyers are definitely being squeezed out of the market. And there are two factors. The first is, of course, that the borrowing power now, in other words, the amount you can borrow for a fixed amount of income and savings, has dropped, typically now about 30% or maybe slightly more. The second is that first-time buyers are being edged out in some areas by some property investors and those who are buying as multi-family subunits. So quite often it could be kids and parents and grandparents all clubbing together to buy a larger property. And we're seeing that especially in some of the areas around Western Sydney at the moment, and some of those are quite often aligned to particular ethnic communities. So there's a lot going on here, but the bottom line is that it's the refinancing story which is the most significant factor. It's driving the average loan higher. It comprises a large amount of the business being written. But what's also interesting is that the loans that banks are making are at very, very competitive rates. So in a way, what they're doing is trading off volume for profitability. Now, of course, they quite often do this, but at the moment it's very aggressive. And that means that banks will be struggling with margin. That has two knock-on effects. The first is it means that their deposit rates are still pretty uncompetitive, frankly. And unless you shop around, you could often find that your access to deposit rates is a lot lower than it should be. The other point is that some existing borrowers who haven't chosen to refinance are paying on average 100 to 120 basis points more a month. That's a significant amount. That's more than 1% higher. So if you have not checked your mortgage rate recently, it is worth checking to see whether you can get better. Now, if you have a high loan-to-value ratio and little savings, that might be more of a problem. But then, of course, everyone says, well, everyone has plenty of buffers. May not be true. So what we are starting to see in all of this is some being able to refinance onto cheaper loans, but others less able to refinance, are paying more and are becoming mortgage prisoners. In other words, nobody wants to touch them. this is another part of the story which will, I think, play out in the months ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.